In the early 18th century, London was transforming into the financial capital of the world. The British economy was growing, but the government was burdened with massive national debt. To manage this debt, the British government created a new joint stock enterprise in 1711. This corporation was named the South Sea Company, and it was granted a special monopoly. It received exclusive rights to trade with Spanish America, including the trade of enslaved people. Investors believed this monopoly would generate unimaginable wealth for the British Empire. But there was a major catch to this highly promising trade monopoly. Spain controlled all of the ports in South America and heavily restricted British access. The South Sea Company was never able to establish a profitable trade route. Despite the lack of actual trade, the company's management had a different plan. They decided to focus on financial engineering rather than physical shipping. The company offered to take over the entire British national debt in exchange for government bonds. To make this deal attractive, the company launched a massive marketing campaign. They painted a picture of endless gold and silver flowing from South American mines. Public excitement began to build, and demand for the company's stock skyrocketed. The stock price rose from £100 to over £300 in a few months. The company's directors realized they could print more stock to buy back more debt. To keep the momentum going, they allowed buyers to purchase stock on credit. People only needed a small down payment to secure a share of the company. This cheap credit fueled a speculative frenzy that swept through all levels of British society. Members of Parliament, wealthy merchants, and ordinary citizens rushed to buy. Famous figures of the era were also caught up in the mania. Even the legendary scientist Sir Isaac Newton invested heavily in the company. By the summer of 1720, the stock price reached £1,000. The company's success inspired dozens of other speculative joint stock projects. People were raising money for ridiculous schemes, including a company to import jackasses from Spain. Another famous project claimed to be for an undertaking which shall in due time be revealed. To protect their monopoly, the South Sea directors lobbied Parliament to pass the Bubble Act. This new law made it illegal to form joint stock companies without a royal charter. But this backfired, causing the speculative market to lose confidence. Investors realized that many of these bubble companies had no underlying value. People began selling their shares, and the panic quickly spread to the South Sea Company. In August 1720, the stock price began its dramatic and unstoppable decline. Within weeks, the stock crashed from £1,000 back down to £150. The sudden collapse ruined thousands of investors across the nation. Prominent families lost their estates, and some ruined investors took their own lives. Sir Isaac Newton lost £20,000, a massive fortune at the time. He famously remarked that he could calculate the movement of stars, but not the madness of men. The British government faced a major political crisis as the public demanded justice. An investigation revealed widespread bribery of politicians and members of the royal family. The company's director had bribed officials to pass the legislation that enabled the scheme. Chancellor of the Exchequer John Illaby was expelled from Parliament and sent to the Tower of London. The task of stabilizing the economy fell to a politician named Robert Walpole. Walpole restructured the company and restored public faith in the financial system. The South Sea bubble became the classic example of a speculative market mania. It demonstrated how easily greed and easy credit can distort rational decision-making. The psychological patterns of 1720 are identical to modern market bubbles. From the dot-com bubble to cryptocurrency manias, the human element remains unchanged. Remember, this is historical analysis, not financial investment advice. Keep your portfolio grounded in real-world productivity.